Plug Power closed its latest trading session on June 18, 2026, at an exact price of $2.85, surging an impressive 7.55% intraday. This sharp push came on massive volume, with over 66 million shares changing hands, a significant jump above its historical daily averages. The market is currently closed for the weekend today, Saturday, June 20, 2026, meaning this $2.85 mark stands as the official line in the sand until the opening bell rings on Monday morning. While retail investors on various social media platforms are celebrating this single-day spike as a massive victory, the underlying reality is far more complex and tactical. The unexpected driver behind this sudden interest is not a random wave of retail hype, but rather a calculated liquidity play. Plug Power recently disclosed the strategic sale of a federal investment tax credit tied directly to its St. Gabriel hydrogen liquefaction facility. This asset monetization effort injected immediate non-dilutive capital into a balance sheet that has spent quarters under extreme stress, creating a sudden curiosity loop for institutional players who had previously left the stock for dead. The general market narrative surrounding Plug Power is easily identifiable if you spend any time browsing investing sites or looking at discussions on the Robinhood app. The common belief is that the company is a chronic wealth destroyer, locked in an endless cycle of burning cash, missing targets, and diluting existing shareholders to survive. There is obviously merit to that view given the multi-year downward trajectory from past highs. However, the contrarian reality developing beneath the surface forces us to look past the surface-level panic. While the crowd has been aggressively dumping the stock, driving it down roughly 38% from its 52-week high of $4.58, major industrial metrics are quietly shifting. The expectation was that the company would completely run out of runway, but the reality reveals an aggressive cost-cutting framework known internally as Project Quantum Leap. This initiative is designed to push the company towards positive adjusted earnings before interest, taxes, depreciation, and amortization by the fourth quarter of late 2026. Analyzing the intense recent stock movement reveals a battlefield between short sellers covering their positions and institutional accumulators testing the waters. Before this single-day 7.5% rally, Plug Power was locked in a brutal 8-day losing streak that wiped out 33% of its market value, dragging its market capitalization down to $3.9 billion. Volatility has been the defining characteristic of the trading volume over the last month. When you look at the wider macro landscape through platforms like the Interactive Brokers platform or the Fidelity Trading platform, you can see that institutional activity has been highly defensive. Large funds have been demanding proof of execution rather than accepting future promises. The recent daily swings, moving between an intraday low of $2.64 and a high of $2.86, show that traders are pricing in extreme binary outcomes. Sector momentum for clean energy has been sluggish due to persistent macroeconomic pressures, specifically restrictive federal interest rate policies that make financing capital-intensive utility infrastructure incredibly expensive. Yet the massive volume spike during the latest session suggests that at $2.65, big players decided the risk-to-reward ratio had finally skewed in favor of the bulls. To truly understand how this asset compares to the broader ecosystem, it is worth looking at how modern portfolios handle speculative green equities. Investors utilizing automated allocation models like Schwab Intelligent Portfolios or those engaged in self-investing through an individual brokerage often struggle to categorize a stock like this. It sits in a vastly different risk bucket than foundational holdings like Apple stock, Tesla stock, or Nvidia stock, which dominate standard tech allocations. When people look for investment help or choose to invest online, they are often told to seek out stability. However, active traders using the SoFi trading platform or looking through specialized Fidelity ETFs look for dislocation between short-term liquidity and long-term asset value. Plug Power currently presents exactly that kind of structural dislocation. Its trailing 12-month revenue sits around $740 million, meaning it trades at roughly 5 times sales. While that is a steep premium for an unprofitable enterprise, it is a massive discount compared to where the hydrogen sector traded during previous market peaks. The massive trading volumes we observed on the Robinhood stock trading app indicate that retail fractional shares are flowing into the stock, betting heavily that the bottom is firmly established at the $2 psychological support floor. Let us pull back the curtain on what this company actually does to contextualize these wild market swings. Plug Power operates as a vertically integrated provider of hydrogen fuel cell systems, turnkey hydrogen fueling stations, and green hydrogen generation infrastructure. Their core commercial footprint was historically built on material handling solutions, providing hydrogen fuel cells to power forklifts inside massive distribution centers managed by retail giants like Amazon and Walmart. Over the years, the business model expanded significantly into the production of industrial electrolyzers, which utilize electrical currents to separate hydrogen from water, offering a zero-emission alternative for heavy industry. Looking back at older financial reports, the operational reality has been undeniably harsh. In 2023, the company pulled in $891 million in revenue, but posted a staggering net loss of $1.37 billion. The situation worsened in 2024 when revenue stalled out, dropping 29% to $629 million, while losses ballooned to over $2 million as global corporations temporarily paused expensive green infrastructure projects. This historical performance explains why the consensus view on the Interactive Brokers platform remains deeply skeptical, labeling the business model as an expensive proof of concept that struggles to scale efficiently without external aid. Comment below how many shares of Plug Power you currently hold in your portfolio, or if you are entirely avoiding the clean energy sector right now. Looking closely at the underlying operational fundamentals, however, shows that the commercial engine is actually accelerating despite the stock price depreciation. In the first quarter of 2026, Plug Power reported a 22% year-over-year revenue increase, reaching $163.5 million. The absolute standout driver was their electrolyzer division, where revenues surged by an astonishing 345% year-over-year. This growth is backed by genuine commercial wins, including a 30-megawatt contract in the United Kingdom to supply specialized proton exchange membrane electrolyzers and a massive 275-megawatt front-end engineering design contract with Hy2Gen in Canada for a major decarbonized ammonium nitrate project. Globally, the company has deployed over 320 megawatts of electrolyzer capacity, and its forward opportunity pipeline is estimated to be valued at greater than $8 billion. Furthermore, operational efficiencies are beginning to materialize. Service costs per deployed unit fell by more than 30% year-over-year, proving that the company is finally learning how to maintain its infrastructure without bleeding capital at the historical rate. When you analyze the company's financial health through the lens of a traditional Fidelity brokerage or SoFi Invest account, liquidity remains the primary metric to watch. Plug Power ended the first quarter of 2026 with more than $802 million in total cash, cash equivalents, and restricted cash. While that provides a comfortable short-term cushion, total liabilities stand at $1.59 billion, resulting in a debt-to-equity ratio of 2.1. To combat this pressure, management is aggressively pursuing asset monetization strategies, projecting an additional $275 million in cash inflows throughout the remaining months of 2026. The real risk that keeps institutional analysts cautious on the Robinhood Investments platform is the historical trend of shareholder dilution. The company has more than doubled its total outstanding share count over the last 3 years to fund operations. This constant capital printing acts as a heavy anchor on the earnings per share metric, which currently sits at a negative $1.32 on a trailing 12-month basis. The future outlook for Plug Power hinges entirely on a classic tension between expectation and reality. The market expects the company to miss its targets, continue diluting shareholders, and succumb to structural liquidity constraints before its green hydrogen projects achieve scale. If the reality merely matches this pessimistic view, the stock will likely break through its 52-week low of $1.03 and become a permanent penny stock. However, if the reality exceeds expectations by hitting the projected target of positive adjusted EBITDA in the final quarter of late 2026, the short squeeze potential could be monumental. Wall Street analysts remain sharply divided on this trajectory, holding a consensus rating of a neutral hold. The mean price target across 35 prominent analysts rests at $3.52, offering a modest 22% upside. Yet the variance is wild, with the most optimistic bulls forecasting a climb to $7 per share, based on accelerating data center energy demand, while the most aggressive bears see the stock cratering to 75 cents if federal clean energy subsidies are altered. Ultimately, the trajectory of this clean energy asset will be determined by execution rather than narrative. For individuals managing their own capital across various online investing sites, the decision to hold this stock requires balancing the cold financial reality against an expanding commercial footprint. The latest single-day gain of 7.55% up to $2.85 proves that the asset can rally aggressively on the slightest hint of positive financial news. The sale of the St. Gabriel tax credit provides the immediate cash needed to bridge operations toward the critical final quarters of the year. Investors must weigh the clear risks of past operational underperformance against a massive $8 billion project pipeline and surging global demand for green hydrogen solutions. As the market continues to digest these developing fundamentals, Plug Power remains a highly volatile, high-stakes battleground where the ultimate separation between expectation and reality will dictate the fortunes of everyone involved.